If you currently live in the state of Florida and you are considering selling your primary residence and purchasing another home or property within the state, you might be interested in learning more about tax portability. Tax portability is a great way to transfer all or most of your tax savings from the Save Our Homes exemption to another home within the state of Florida. Why this is a popular option for many of you watching today's video is you've owned your home for many years and your current property tax bill is very low due to the Save Our Homes exemption, which basically caps the yearly increases in property taxes near 3% year over year. Let's say you've lived in your home for 20 years. You are paying much lower property taxes compared to someone who just purchased in recent years. This is where using the portability comes in handy during today's video. Throughout today's video, I'm going to show you 6 different examples of how to calculate future tax savings, both moving up to a larger, more expensive home and downsizing to a less expensive home. As well, we're going to cover what the maximum dollar amount is that you are able to transfer in the portability. And if you're new to my channel, my name is David Rogers. I'm a licensed real estate broker, currently living in Palm Beach County, Florida. And if you're looking to buy or sell real estate anywhere from Palm Beach County to Martin County or Port St. Lucie, I encourage you to call me, text me, or shoot me an email anytime. All my contact information is throughout today's video, down in the description below. Now let's get started and show you some different examples, how the tax portability works and how to calculate how much money you're going to save on your future home. So our first example, we're going to do a scenario where the current home you live in currently has a market value of $600,000. Now let's clarify a few things first. The market value may not be how much your home would sell for in the current market. This is based on what the property appraiser is valuing your home at currently. Now, in the first scenario, the market value of the home is $600,000. The assessed value that you're paying taxes on is $250,000. That gives you a Save Our Homes portability equal to $350,000 if you're moving up to a more expensive or larger home. So if you're going to buy a more expensive home, here's some calculations we're going to use in this first scenario. Let's say that you're going to buy a new home for $850,000. You're going to take the $350,000 right here. You're going to subtract that from $850,000. And then in most cases, most of you are going to get the additional homestead exemption of $50,000. That's a total of $400,000 you're going to subtract from $850,000. That leaves you with a new assessed value of $450,000. That's what your current taxes are going to be based on moving forward. There's a lot of different websites, depending on what part of Florida you're considering moving to, that you can go there and punch in all the numbers based on your home per se. Now let's do this one more time before we move on to the next example as well. So the current market value is $600,000 of the home that you live in now. Again, this is just an example. The assessed value is $250,000. Again, somebody probably owned this home for 6, 7, 8 years, especially with the boom we had in the recent 4 to 5 years. So your Save Our Homes portability portion would be equal to $350,000. So if the new home you're going to purchase is $850,000, you're going to subtract the $350,000, which is this number right here. Then you're usually going to get the additional homestead exemption of $50,000. That leaves you, if you subtract $350,000 and $50,000, that leaves you with $450,000 for your new assessed value. Now let's move on to the second example if you're moving up to a more expensive home. The next example would be, let's say the current market value of your home is $500,000 and your assessed value is $350,000. you would have a Save Our Homes portability equal to $150,000 to use if you're going up to a larger home. So in this scenario, we're going to take a new home market value, that's the home you're going to purchase somewhere else in the state of Florida, for $650,000. You're then going to take the $150,000 and subtract it from the $650,000, which is the new home market value that the tax appraiser office that you're moving to values the home. Then, of course, if you have the additional homestead exemption of $50,000, and let's back up a little bit. Of course, there's other exemptions that you may personally qualify for, but for today's video, we're just going to use the basic $50,000 exemption we see in most scenarios. So again, the new home market value of $650,000, you're going to subtract the Save Our Homes tax portability, which is equal to $150,000. Then you're going to subtract the $50,000 for your standard homestead exemption. That leaves you with a new assessed value of $450,000 in this scenario if you were selling your current home and moving up to a slightly more expensive home in the state of Florida. And remember, this has to be your primary residence, and you had to have your homestead exemption filed for the property you're in currently. Now let's move on to the third example. If you're upsizing to a much more expensive home, and this is where you need to pay attention to know what the maximum amount is that you can apply. So in this next scenario, let's say that your market value of your current home is $1.2 million and you have an assessed value of $600,000. Now, I know most of you are going to quickly go, oh, well, that's $600,000 that we can do on their Save Our Homes portability. That's wrong. The maximum that you can transfer in portability is $500,000. So in this scenario, we get to take $500,000 and apply it to the next property. So now let's say the new home you're purchasing somewhere in the state of Florida has a new home market value of $1,650,000. You would take this $500,000 of the portability from your previous home, then get your standard homestead exemption of $50,000. That will leave you with a new assessed value of $1,100,000 you can anticipate paying in future property taxes. So you did get to transfer over $500,000 in this scenario that you're going to save on the future purchase. Now let's go to 3 different examples if you're going to purchase a less expensive home. All right, so now in this example, let's say that you're going to downsize or sell your current home and purchase one that costs less money than your current home. So in this scenario, the market value of your current home is $600,000 and you have an assessed value that you're paying taxes on of $250,000. That leaves you a Save Our Homes portability of $350,000. Now this is where it changes, and if you weren't paying attention in math class, you're probably not going to be able to figure this out on your own at this point. So the new home that you're looking at somewhere in the state of Florida is $500,000. Now, how we figure out how much of this $350,000 we can use towards a purchase on the next one, we have to do a calculation. We have to take the $350,000, which was the portability from the previous home that you're going to sell. We have to divide that into the market value of your current home you're selling. And if you do this, if you divide $350,000 into $600,000, that's going to equate to 0.58. Now 0.58, here's what we're going to do next. We're going to take the market value of the new home you're looking to purchase, which is $500,000. You're going to times 0.58, which is the calculation we just got right here. You're going to time this by $500,000, which will give you $290,000. So this 290 is less than the 350 because when you're downsizing, you don't get to use the full amount. It's all based on a percentage. So in this scenario, you would subtract 290,000 from the 500,000. So 290 minus the market value, that leaves you $210,000. Now, this does not include your standard homestead exemption of $50,000. So in that scenario, you would subtract 50,000 off the 210. That would give you roughly $160,000 of assessed value that you will have to pay property taxes. Again, these are just good estimates. I would always advise you to reach out to a tax professional that does this for a living. And another thing I wanted to point out, so when it comes to the timeline to file for this, I want to point something else up real quick, and I messed this up. But you have basically until January 1st. So if you sell your home, and let's say you don't buy a home for another year or so, you have until January 1st of the third year after giving up your prior homestead exemption to request the new exemption and claim exemption portability. The tax benefit that may be ported over to your new home, again, is capped at $500,000. And again, if you need more clarification, just call me, text me, shoot me an email. I'll be happy to help answer any questions you have. Now, let's go to another example if you're going to sell your current home and buy a less expensive home. So in this example, we're going to keep the market value of your current home at $600,000, but we're going to change it to show that the assessed value is $450,000. So this would be a good example if you bought the home in 2021 and it went up in market value, but your assessed value is a little less. So market value currently is $600,000. The assessed value is $450,000. That gives you $150,000 of available portability to transfer over to your next property or the lower price home. So the next home, the market value is $400,000. And how we're going to come up with the percentage or the amount that we could transfer, we're going to take the $150,000, we're going to divide it into the $600,000 right here. That's going to give you 0.25. So then what we're going to do from there, again, you take the $150,000 of the portability amount and you divide it into the market value of your current home you own. Now we're going to take 0.25 and we're going to times it by the market value of the new home you're looking to purchase, which is less money. That will give you $100,000 that you can apply in the portability for the lower price home that you're looking to purchase. So now again, you take 100,000 minus 100,000 is this number here, and you're going to subtract it from the new home market value of 400,000. That gives you $300,000 that you get to apply. Now this does not include your standard homestead exemption of $50,000 or whatever else you may qualify for, of course. In that scenario, your new assessed value that you would pay property taxes on will be around $250,000. Now let's go on to the third and final example. Now our final example of selling your current home and buying a lesser price home is going to be a little bit different. So let's say the current market value of your home right now that you're selling is worth $1.2 million and the assessed value equals $600,000. Now, most of you are going to go, oh, great, I get $600,000 that I get to play with. Remember earlier, the maximum you can do the portability on or transfer is $500,000. So in this scenario, you get $500,000 that you're available to transfer to the next property. But because the other property you're looking at is less, it's a lower price home, we have to use the calculations to determine how much of that $500,000 you can actually use. So again, the new home that you're looking to purchase is $700,000. We are now going to divide the $500,000, which is the portability, maximum portability. You're going to divide the $500,000 by the original market value of the home you're looking to sell of $1.2 million. That's going to give you a calculation of 0.41. So again, you take the $500,000 of the portability amount, you divide it by the value of your current home, and that'll give you 0.41. Now, we have to times the 0.41 by the market value of the new home you're looking to purchase. So in this scenario, the market value of the new home you're looking to purchase is $700,000. You're going to times 0.41 by $700,000. That gives you a portability amount of $287,000 that you get to use on the new purchase. So subtract $287,000 from $700,000, that leaves you $413,000. And again, that does not include any standard deductions, the $50,000, if you had a widow deduction, a disability deduction, and so on. So that would bring it down to $363,000. So remember, when you downsize, you don't get to use the full amount of the portability. You only get to use up to the maximum amount of $500,000 when you go up to a more expensive home in these scenarios. So again, I hope you enjoyed today's video. It might have been boring to many of you. Trying to figure out the portability, which is a very important thing if you're considering selling your home and it's your primary residence to move to another home in the state of Florida. This is a way for you to save money on future purchases, regardless if it's going up or going down. You know, a lot of states don't offer this. Every state is different what they offer. This is one benefit that the state of Florida has and offers its residents. Also, we have the same Save Our Homes exemption, which created most of this portability in today's scenarios. So again, if you're looking to move to Port St. Lucie, Palm Beach County, Martin County, if you're looking to purchase a home, you're looking to sell a home, or if you know anybody looking to buy or sell real estate, I would love the opportunity and encourage you to call me, text me, or shoot me an email anytime. Again, my name is David Rogers. I'm a licensed real estate broker here in Palm Beach County, and I specialize from Palm Beach County up to Port St. Lucie, Florida. And if you haven't done so already, make sure you subscribe to my channel, leave comments of what you thought about today's video, give it a thumbs up, and smash that like button. And we'll see you on the next video coming out real soon.